Imagine this. You wake up one morning, coffee in hand, ready to seize the day. But then you check your bank account. It's frozen. Your money, your life savings, held hostage. No warning, no explanation. Panic sets in. This isn't some dystopian nightmare. This was the harsh reality for millions during the recent banking crisis. From Silicon Valley entrepreneurs to everyday folks, people were left reeling as their financial worlds went dark. How could this happen? The answer is both simple and terrifying. The system is rigged. The banks we trust with our hard-earned money aren't the fortresses of stability we once believed. They're more like casinos, gambling with our deposits in a high-stakes game of financial roulette. And guess who always seems to win? Spoiler alert. It's not us. This essay will take you on a wild ride through the twisted maze of the modern banking system. Buckle up, because it's about to get bumpy. Remember that stack of papers you signed when you opened your first bank account? Yeah, no one actually reads those, but buried deep within that legal jargon is a shocking truth. When you deposit money in a bank, it's not yours anymore. You've essentially lent it to the bank, making you an unsecured creditor. And like any good creditor, the bank can change the terms of the loan whenever they damn well please. This legal sleight of hand dates back to an 1848 Supreme Court case, Foley v. This landmark ruling established that deposited money becomes the bank's property. Think about that for a second. The money you earned, the money you saved, it's not really yours once it crosses that velvet-roped threshold into the bank's vault. But wait, it gets worse. Banks are legally allowed to restrict withdrawals, even if it means you can't pay your rent or buy groceries. They can do this because, well, they wrote the rules. And those rules are designed to protect the banks, not you. Here's where things get really interesting or terrifying, depending on your perspective. Banks operate on a system called fractional reserve banking. In a nutshell, it means they only keep a small fraction of your deposits on hand, typically around 10%. The rest? They lend it out, invest it, or use it to buy fancy art for their executive bathrooms. This system works great, until it doesn't. When people lose faith in a bank, often for a very good reason, they rush to withdraw their money. It's like a scene from It's a Wonderful Life, but with less holiday cheer and more existential dread. This is called a bank run, and it can bring down even the mightiest financial institutions. The 2023 banking crisis was a stark reminder of the fragility of this system. Over $1 trillion in deposits were frozen across multiple bank failures. Businesses crumbled, livelihoods were shattered, and the financial system teetered on the brink. Silicon Valley Bank, SVB, the darling of the tech industry, went from boom to bust faster than you can say venture capital. How did this happen? A perfect storm of rising interest rates, poor risk management, and a good old-fashioned bank run. On March 9, 2023, spooked depositors withdrew a staggering $42 billion, triggering a panic that sent shockwaves through the financial system. SVB, the 16th largest bank in the US, collapsed like a house of cards. Suddenly, businesses that relied on SVB for funding were left high and dry. The FDIC, the government agency that insures deposits, stepped in to prevent a complete meltdown. But there was a catch. The FDIC's standard insurance limit is $250,000 per depositor, per bank. Many SVB account holders had far more than that at stake. Luckily, the FDIC invoked the systemic risk exception to cover uninsured deposits. But this was an unprecedented move. The question is, will they always be able to bail out the big players? Section 5. Echoes of Greece. Capital controls and the erosion of trust. Remember Greece in 2015? No? Well, let me refresh your memory. Facing a crippling debt crisis, the Greek government imposed capital controls, limiting cash withdrawals to a measly €60 per day. Imagine trying to run a business, pay your bills, or simply live your life with that kind of restriction. While Greece might seem like a distant example, it's a chilling reminder of what can happen when governments panic and financial systems teeter on the brink. And it's not just Greece. In recent years, we've seen similar restrictions imposed in Cyprus, Lebanon, and other countries facing economic turmoil. Section 6. The Digital Dilemma. Convenience at what cost? Remember those charming bank branches with their friendly tellers and free lollipops? They're going the way of the dinosaur, Banks are rapidly closing physical branches, herding us towards a cashless, digital-only future. Over 13,000 bank branches have vanished from American streets in the last 5 years alone. Sure, online banking is convenient, but this shift to digital has a dark side. What happens when there's a system outage or a cyber attack? What happens when the internet is down or your phone battery dies? You're left stranded, unable to access your own money. And don't even get me started on those new bank terms and conditions. Banks are quietly slipping in language about withdrawal limitations and service disruptions, essentially giving themselves carte blanche to restrict access to your money whenever they see fit. Section 7. The new normal. Bracing for the next crisis. Here's a fun fact. Leaked documents have revealed that major US banks have been running simulations for withdrawal restriction scenarios. That's right, they're actively preparing for the next time they need to freeze your accounts. They know it's not a matter of if, but when the next crisis hits. Stanford economists have been sounding the alarm too. They warn that rising interest rates are eroding bank asset values, increasing the risk of technical insolvency. In other words, the very foundation of the banking system is on shaky ground. Section 8. Safeguarding your financial fortress. So, what can you do to protect yourself in this brave new world of financial uncertainty? Here's the good news. You're not powerless. Knowledge is your best defense. First, understand the FDIC insurance limit. It's currently $250,000 per depositor per bank. If you have more than that stashed away, consider spreading it across multiple banks to minimize your risk. Second, maintain an emergency cash fund outside the banking system. Keep a few $100 or $1,000 in a safe place at home. It might seem old-fashioned, but having some cold, hard cash on hand can be a lifesaver in a crisis. Third, diversify your assets. Consider investing in tangible assets like treasury bills or precious metals. These assets tend to hold their value during economic downturns and can provide a hedge against inflation. Finally, and I know this is a radical idea, read your bank's terms and conditions. I know, it's about as exciting as watching paint dry, but understanding the fine print could save you a world of heartache down the road. Section 9. Conclusion. The future of money. The recent banking crisis was a wake-up call. It exposed the inherent fragility of a system built on debt, speculation, and a healthy dose of opaqueness. The days of blindly trusting banks with our financial well-being are over. The future of money is uncertain, but one thing is clear. We, the people, need to be more informed, more engaged, and more proactive in safeguarding our financial futures. We can't rely on governments or institutions to protect us. The power, as always, lies with the people. So, let's start using it.